I'm with Vista Ventures. Vista Ventures focuses, we're a regional venture fund, so we like to invest in the region. And we do that because we love early stage. And early stage has always been a local business. I mean, the Bay Area kind of forgot about, people don't think of the Bay Area as local, but they are local funds as well, because to do really good early stage, somebody needs to be close to the company. And what we like to look at, first of all, is where are their core competencies in the region? Because if there's a core competency, you have a higher probability of building a leadership company. And we have to build leadership companies not in the region, but internationally. So we look at core competencies of the region, and they include things like obviously networks, communications and storage, software, and a category called data and media services. And that could be, internet media, but also when you think about data services, companies like First Data, there's a lot of companies like that that have been in this region, and so those are the things that we focus on.
I'm Jason Mendelson with both Mobius Venture Capital and the Foundry Group. Mobius has offices in Palo Alto and Boulder. Foundry Group is a subset of the Mobius folks, raising a fund here in Boulder. We're going to do a third of our deals as we've done in the past in the Colorado area, a third in California, and a third everywhere else. But I'm happy to say not India and China, that we've done a lot out of the Mobius fund, because, well, that will make you turn your hair as gray as mine. We like you, we love to do early stage stuff. I think, the presentation that we saw up here is completely not applicable to most everything that we do. That was big company private equity, and it sounded really cool and neat, and the guys had great ties, but that's not what we do. I'm not going to go on for 2 minutes. Here you go.
Chris Scoggins with Sequel Venture Partners here in Boulder. Like these guys, we do early stage. We are primarily focused in the mountain region. We opportunistically look at some stuff out of region. We do about 2/3 of our deals in information technology and about 1/3 in life sciences. And we'll probably get a lot of questions around, what does early stage mean? That definition's changed a lot. And while we do some seed deals, we primarily do kind of first institutional Series A deals.
Derek Pilling with Meritage Funds. We're a communications-oriented family of venture capital funds. We've got a little over $570 million of capital under management. We tend to do two types of transactions. The first are early stage. We'll actually do pre-revenue, seed-oriented transactions in our portfolio. We've got a program we call Fast Start that is specifically intended for that, where we can put up to $1 million into a company on a very quick, sort of short diligence cycle basis. More traditional venture rounds on the A side, early stage, are $3 to $5 million for us. The other type of thing we like to do are what we call complex transactions. I hope nobody in the room ever has a need for one of those. They're tough deals. They're recaps, restructurings, turnarounds, spin-outs. They're deals that take a lot of operational talent to bring to bear to fix a broken company. And the real differentiation for our firm is that we've got 4 guys on our team, which are serial communications industry entrepreneurs that sit on boards of directors for us. We don't have traditional venture investors sit on boards. We have operators sit on boards on our behalf. And we think that model works pretty well.
So our fund is called Lacuna. And if any of you are brushing up on your Latin, you'll know lacuna means a gap or a missing space. And we sort of let the market tell us where to invest. The market sort of told us that there was a gap between angels and VCs in the Front Range region. So we've identified the $500,000 to $3 million gap as the area we're going to focus on. We're 5 partners. None of us have come from venture capital, though 2 of us have come from investing. 2 of my partners came from Goldman Sachs, where they were actually brokers and stock pickers, and very, very successful at it. Over the last 6 or 7 years, they've been running a syndicate of angels. I met them on the board of At Last, which was a local company, made a product called SketchUp. And we ended up selling the company just about a year ago to Google. And so one of my partners was the former CFO of the company, J.K. Hullett. The other was the original funder, Raleigh Rawls. We have 2 other partners, one of whom was a partner of Raleigh's in a hedge fund and at Goldman, and then another is Wink Jones, who was CEO of a local company here that also sold last summer called Net Identity. My personal background is I've started 2 companies, CEO'd them both. One was an operationally intensive company. I ran hotels and restaurants on the Jersey Shore. The second one was a brand strategy firm called Kindred Kazaya, had offices here and in New York City, and we worked with, just name it, a huge group of very large Coca-Colas, IBMs, General Motors, Kellogg's, people like that. So what we bring to the party is, first of all, a passion for very, very early stage. But we also bring a lot of operational expertise as well. Sounds like you guys bring the same type of expertise. But we do like to get deeply involved in the very early stage and help companies really set their strategies and help them flesh out their teams as well.
Since I've been investing here since '92, I guess I have the most historical perspective. Like a lot of things in venture, everything goes in waves. There was a time when it was easy to bring VCs in. I mean, during the bubble, everyone was putting lots of money. People were coming in without, even local leads. And then after the bubble burst, everyone went back and stuck to their knitting, and they stayed, in their home territories and cleaned up their own portfolios. And a lot of the deals we did in the 2000 to 2002 timeframe would be syndicates amongst the locals, because it was very difficult to get outsiders because they were just busy cleaning up their own messes in their portfolio. And then, it got back to, especially when the three coasts, when things get really hot there and prices start going up, then some of the funds want to come across the mountains again because the pricing here is good and you can get good quality companies. So I think it goes in cycles. At least that's what I've seen for the last 15 years.
Yeah, the one thing I'd add is 10 years ago, people didn't think Colorado had management talent. You had good technology people. You didn't have COOs. You didn't have CEOs. You didn't have VPs of sales. Mm-hmm. I think there's been enough turnaround and turnover of companies that management talent now exists. So outside VCs say, you know what, we can run a company out of Colorado and not have to either bring them to California or import an entire management team.
This is actually like core part of our strategy at Sequel is to syndicate all of our deals. And so we're very proactive about this. And if you look at just the aggregate numbers, Colorado imports about 80-85% of its capital and has for the last 10 years. And I don't really see anything that's going to change that. I think about $550 million was raised in Colorado last year, give or take. And that seems to be about steady state if you take out the bubble. And most of that capital comes from out of the state. So we as a firm, when we find things, again, because we focus locally, when we find stuff, we definitely try to go out and find partners. And we've been pretty successful at doing that. But again, we work very hard at it. We're very proactive about it.
Yeah, I think the bar is always going to be higher here for out-of-state VCs to come in. And it's a pretty simple reason. Venture capitalists are lazy. Okay, the California guys and the East Coast guys don't want to have to get on a plane because there is so much local deal flow. They can literally go 2 blocks away and see a great company. So the bar is always going to be higher. I think some of the issues around management talent persist in this market because whether it's reality or not, it is perception. And it takes a long time to change that perception. We sort of look at this, we call it the valley of death, and it's the B and the C round of financing a company. And we've always felt and continue to feel it's very difficult at those rounds to bring in outside capital to a company. And so we tend, and you as entrepreneurs may want to consider, try to build syndicates early for your investments that can support you through those growth equity rounds. And make sure that your investors have reserves available to participate in those rounds because it really is very difficult to bring in new investors from the coasts here locally.
I think it's true. We don't have nearly the depth of talent, but it is increasingly easy to recruit here. And there's enough core. Used to be, people didn't want to move here because if that company wasn't successful, what was I going to do next? It's quite different now. There is a core platform underneath. There's a core set of entrepreneurs and executives, and you can recruit fairly easily. Do we have to recruit? Yeah. I mean, it doesn't all exist here. We're just not nearly that size, but it's increasingly easier to do that.
Yeah, I mean, I just moved out 9 months ago with another partner of mine. So, I mean, I'm still getting my feet wet around here, but I've told several of you in the audience today, I keep waking up going, when's the bloom going to be off the rose? This place rocks. Why would I ever want to be in the Silicon Valley? Why would you ever want to start a company in the Silicon Valley? No, I'm not going to. Yeah, I'm just telling you folks, right? And this isn't being taped, right? No, but exactly. Oh, hi, Boston. No, but I mean, honestly, I mean, I was asked the other day. I was telling you this in a seminar. How do we make Boulder like the Silicon Valley? And I was like, why the hell would you want to make Boulder like the Silicon Valley? Why would you want to make Denver? I mean, yeah, we've got our issues, but we could sit here and I could go on for 2 hours about all the problems it is about being a VC or being a company in the Silicon Valley. So, on the margin, okay, I've been here 9 months, so this is kind of what you will. To me, this is an easier place to start a company. It's cheaper, right, to build and start a company. It's easier to get good VCs who are really going to work at the companies. I mean, everybody up on it, you're right, VCs are lazy, but I'll tell you, they're certainly not working in Boulder. They may be in this Silicon Valley, getting their transmissions fixed on their Ferraris, but the folks out here seem to really want to put in an honest day's work. So, let's not make it all doom and gloom. This is a great place from everything I've seen, and I think it's easier than the Bay Area.
Yeah, I also moved out here just a few years ago, and I was at a venture capital firm. I spent 6 years in San Francisco and 2 years specifically at a firm out there, and there's a lot of drawbacks there too. I find that the employees here are much more loyal. They don't hop companies like out in the Bay. That's a big deal when you're in an early stage company. Is the core team, the core engineering team, going to kind of be together? Or are you going to be kind of pulling bits and pieces every 9 to 12 months, rotating your team? That's really hard to do when you're building a product. So I've been very pleasantly surprised here. The technical capabilities here are unmatched. They're excellent, top notch. The one area that I think, and even the CEO ranks, I think is fairly strong. We do tend to recruit. We do national searches, and sometimes we find people here, and sometimes we pull people from outside of the region. The one area that I think we are a little bit weaker on, that is strengthening, but we still aren't quite at the Bay or Boston, is kind of strategic marketing. It's the gap between, there's a lot of really good technologists here that are smart technologists who just want to go build product because they think that's what the market wants. A good company goes and understands what the market wants and then builds that. So the marketing drives the technology, and that's not the case so much here from what I've seen. In the Bay, they're really methodical about that. So that's one area that I think we need to work on a little bit. But we're recruiting. As we recruit more and more people out here in that role, they want to stay and do different companies. So that's something I think will build up over time.
I would just echo Chris's comments, especially about the marketing piece. And I actually do have some domain expertise in that area. In fact, these guys at Sequel held a little, a cocktail party or something around marketing for other VCs in the area, because it really is a major gap. I ran a brand strategy firm here for 10 years, and literally every senior person I hired, I had to import from overseas or the East Coast or the West Coast, and it was pretty onerous. We spent a lot of money on recruiting, a lot of time, a lot of energy. And now that I'm sitting, in the dark side, I've noticed that our portfolio companies really do struggle to find people who have any kind of advanced or sophisticated marketing understanding. For the most part, there's some great people out here, but they really are of very high value as far as I'm concerned. And it's probably the area we're adding the most value to the companies we're investing in, just because they have great operators, typically great technology people, great CEOs, but the go-to-market piece is really a place where they struggle. We're really early stage, but we've made 4 investments, and I think we're investing earlier stage than these folks are as well, for the most part. I think, as far as we're concerned, you can sort of see the hunger and the energy of these entrepreneurs, and you got to give them the shot to run the thing. But we're really upfront when we're discussing with them their role in the future. And we just like to ask them how far they envision themselves leading the company, and then trying to knit that back to their background and their experience, and to kind of set expectations early on. If they can move beyond that, great. But if not, we really like to have an upfront understanding that if this thing really takes off, we're going to need to bring in outside management. On the At Last company that I sat on the board of, we had to bring in outside management at a certain point, and it was the right thing to do. The entrepreneur is an incredibly creative person and wonderful at, vision, but he wasn't an operator. They needed an operator.
Yeah, I mean, to ask the question, I'd say that most of our management teams get swapped out over time. The question to ask is, was that voluntary or involuntary? And it's actually a very small set that's involuntary. I mean, most people who start companies don't want to run companies. Starting and building a company is a whole different animal than running a company. I think, we could probably all talk about why we do early stage. I think it's a combination of we think those are attractive returns, but I bet you a lot of us, it's fun, right? It's not so fun sitting on a big company that's doing great, and that's cool, but you get to sit there and everybody comes in and talks about 409A evaluations and SOX compliance and accounting, and suddenly you're like, well, what am I doing here? So, as much as we have that, and we've got a vested stake, you find with the entrepreneurs that, there's not a ton of people who have an interest in really starting a company and then taking it all the way through.
And that's the hard work of early stage investing. We do wind up in a lot of cases needing to bring in a new CEO. I think as Sandy was saying, though, you go into it and you have an honest conversation with the entrepreneur going in, what that might look like. You give them a chance, but you have to do that. And for us, it's somewhat of a measure how often the founder stays. Did you treat him, were you upfront, him or her, upfront enough about it that they want to stay at that company and continue building it and continue learning, so that maybe next time they're the recycled entrepreneur that gets to stay to be the CEO. But it is the work of early stage venture. You wind up needing to make management changes. And the example I always, entrepreneurs are often frustrated, right? Because it feels like a catch-22. Well, how am I going to get you want an experienced entrepreneur, how am I going to get the experience if you don't do it? And why do you guys do that? And then you can just give the simple example of the first time you did a PowerPoint presentation. How long did it take you to make your first PowerPoint presentation? How long did it take you to do your second one? And in a lot of these companies, sometimes time really matters, and you don't have enough time to let the entrepreneur try everything for the first time and take that amount of time. And that's an analogy people get. Now, again, it's great if they stay because they're a real emotional piece of the company, and they have a lot of value. And so I think it's how you change out your management teams and continue working with your founders.
Yeah, the point about voluntary leaving is really important. We rarely, when we get rid of someone, it's usually because it's no. There's a point. There's a point to this. You're usually replacing them, and they're usually finding another position in the company. Typically, the people we fund, because they're very early stage, are more technical, so they're more right to be the CTO, not and bring in a CEO. We also really focus on, if you start a company, you're going to own a lot of the company. So you should think of yourself as a large investor. You probably are the largest single investor as an individual. So the question is, what's success for you? That's one of the questions we ask very early in the process. What do you want to do? What's your goal? Because I talk to people all the time and say, you know what, given the product you have and give it the market you're going after and give it what you personally want to do, you probably shouldn't raise venture capital. You build, a smaller company that you sell for a smaller amount, which is great because you own the whole thing. You exit at $20 million. That's awesome as an entrepreneur, but that's not what VCs are looking for. So just understanding where everyone is early on in the process and what do they think success is really important. We spend a lot of time with that.
Yeah, I think specifically on the management change issue, every early stage company is going to have management change. Whether it works well or not is really up to the entrepreneur. And we'll only tend to get involved in deals where the entrepreneur is self-aware, has a realistic assessment and understanding what they're good at and what they're not good at. And let's face it, we've all got strengths and weaknesses. We don't tend to back entrepreneurs that don't have that realistic assessment on the front end. And I think all of us have seen too many situations where those management changes are painful. We look to avoid them, and it all comes down to what the entrepreneur understands their long-term role in the company can be.
When we started out saying we focus on the core competence of the region, we're in a wireless mesh network company. We look at wireless because I've been doing wireless for 25 years, and again, at one point you do infrastructure, another point you do apps, another point you do content, but there's always it's a good application area. Storage is strong in the region. There's, again, we do things in the data and media spaces, so we're finding exciting things there. So there's a lot of exciting stuff going on. I agree with Chris. I mean, the pipeline is really good right now. I mean, and people are building real companies now, and that's good.
So we're not smart enough to do biotech, so we're just dumb tech guys. But we try to do two types of things. We try to invest along a theme that we may have or do opportunistic deals. So we've had two themes for a long time. Email is a theme, which we've been investing in for 10, 15 years, which we still see there's stuff to do with email. I mean, email is now the backbone of every business that's around. RSS and blogging and publishing is another theme of ours. And then another theme which we're calling internally implicit web, which doesn't mean anything except for it looks great on a PowerPoint slide, is it's I don't know if it's the next Web 2.0. I mean, Web 2.0 is so overused. I don't know what it means, but there's the internet's been around. There's tons of data. There's tons of people using it, and I think probably all of us are 70% satisfied with actually how we use it. A Google search it sort of works. Vertical searches, stuff like this, different ways of using the internet, whether that's in the community, whether that's being able to surf, surf web pages, with Chris and I at the same time. I mean, there's a whole bunch of infrastructure of what is all this backbone of the internet going to be for us down the road and for our kids and whatnot. So that's kind of another big theme.
Like Jason's group, we tend to be theme-oriented as well, obviously within the construct of the communications industry, where we invest. The three macro themes we're chasing right now and have been investing on, the first is mobile. Anything in mobile right now, significant growth area, whether it's the data side or more mundane tower-oriented businesses. There's just a lot going on there. The second area is what we call internet technology, and it's really bringing that technology base into the communications industry. The highest profile example is VoIP. It's an internet technology. And it's fundamentally altering the communications landscape. And so we think there's a lot of investment opportunity on that theme. The third is sort of a collaboration theme, and that's both consumer and enterprise oriented. And that ability to connect real time almost anywhere you are in the connected world is something we're going to be investing on for a long time, we think.
Well, if Jason isn't smart enough to do biotech, then we're really stupid because we don't do a lot of the things these folks do. We don't really understand data or storage or complex enterprise software. Most of the stuff we're doing is centered around more of an applied type business offering, service or product. The areas, I don't think I mentioned this, but we actually have a hedge fund as well. We have a hedge fund and a venture fund. And so typically they work independently, but sometimes they overlap as well when we find some interesting deals. And I would say between the two, one of the hottest areas we're seeing is sort of defense, homeland security, types of applications, technology applications. We also are seeing a lot in the mobile space, and even in sort of like home networking. I mean, that was the whole, it is, how do we combine TVs and internet? How does that get delivered? We're seeing a bunch of that as well.
One of the gentlemen on the presentation from Boston mentioned alternative energy being a big thing for 2007. Do you guys see any of that in the area here?
I would love to see a lot more of it, actually. I'd love to hear what these guys have to say, but I feel like I've seen very little. And that's kind of surprising to me living in Boulder.
Yeah, there's some interesting institutions here with NRail, School of Mines, Colorado State, CU. There's actually some pretty interesting stuff that's coming out of those institutions. And we've probably looked at 15 or 20 kind of alternative energy plays, depending on how broadly you want to define that, over the last year. Ron Bernal, one of our partners who just joined us from Sutter Hill from the Bay Area, is very focused in that area, both here and in some stuff in California from his network. So there's a lot of material sciences here at CU. It's a very good school, Nano. So there's this alternative energy. Plus, there's a lot of just good old-fashioned energy people here in Colorado, obviously, that are going to take advantage, that really understand the supply chain and the value chain in this world. So they're going to take advantage of their relationships. There's an energy-focused fund here called Altera. That's an excellent fund. So I actually think it's not going to be, I don't think it's going to be like our core pillar, but I do think opportunistically there'll be some good stuff here.
So we have 2 alternative energy deals, including one that I'm on the board of, and it's hot, and there's a lot of money going in there. You got to be careful. The other thing that's scaring me a bit is, lessons learned of all these great companies that were funded in the late 90s on the assumption that there would be a high-speed broadband internet backbone for the United States, which just wasn't there, and it's still kind of crappy, by other country standards. There's a lot of interesting alternative energy companies, and I wonder to myself at night, is there going to be an infrastructure that's actually going to be able to deploy any of these, use these, get these out to market and have revenues? Because at the end of the day, I don't think there's anybody in this room that can say alternative energy is great, but when I'm investing my limited partners' money, they need to make money. It's not a charity. So there's a lot of money, and it's a little scary right now.
We don't even think of it as alternative energy, because when you start getting into the alternative energy space, it's usually pretty capital intensive, whatever you're doing. But there's a lot of interesting things that I would call more in the clean tech space. And that could be, it's usually often materials based. It could be a lighter way of making something. That's not alternative energy, but it's definitely clean tech. If you can take a lot of weight out of airplanes or other things like that. And those are more appropriate for the size of funds that we are. So there's a lot of interesting things in the clean tech arena. But again, you have to be very careful, because there's a lot of dollars. And as you said earlier, this would be a bad time to be putting your money into a big buyout fund. You got to be careful about putting your venture money anywhere where there's a lot of money going.
And to tie one thing that was said earlier on the tape is China, as far as materials science, is more or less kicking our butt. They've got 1,000 times the PhDs working on this on a daily basis. So they're moving. The big oil companies are going to China looking for their next materials science projects. A dude in a business plan is as early as we'll go. So I mean, it's early stage. With a dog. Dog's cool. Although we did that once and the dog pooped in my office, and that was bad. Don't let the dog. Just a little bit of advice out there. Really bad.
Jason, is that when you look at a company or when you actually consider investing in a company?
Both.
For us, the answer has something to do with the industry, right? I mean, obviously, so when we invested, say, in Left Hand, it was long before product shipment, right? It was a company doing hardware, very difficult for a hardware company to bootstrap itself all the way up to customer shipments. It may be slightly different for certain kinds of software, right? There are ways that companies can bootstrap more by getting customers to pay for things, et cetera. So it's not a blanket answer. We have done things that are pre-revenue. I personally probably would not do a dude in a business plan, because that dude has not attracted anybody else to himself yet. And to me, one of the measures of an entrepreneur, I talk about how entrepreneurs are sticky. And that means people, they create a vision of the future that people want to be involved in. People will stick to them. And if they haven't created anything that's stuck to them, if it's just the dude and the dog doesn't count, that's probably not that's probably not far enough along for me. I want to see somebody that has created something that other people get excited about. But we've done pre-revenue, we've done only services revenue, we've done all the way to product revenue. So it's again one of these cases where it's not just a real simple answer. It's a function of the industry. And obviously, people that do biotech, they're so far from revenue. So it really is a function of what you're doing and what it takes. And, I think it really, for most VCs, well, for me, when I talk to entrepreneurs and they're worried about valuation, et cetera, VCs, we're not the risk takers. You guys are the risk takers. We're the risk managers. That's what it comes down to. So there's a number of risk vectors, right? We look at execution risk, we look at technology risk, we look at market risk. There's all these financing risk. I mean, if you're putting an infrastructure play and you're going to need several $100 million, the more risk vectors you take out, right, the less risky it is for us and the higher the valuation is going to be. So when somebody asked earlier, what if I bring a management team together that's already, done stuff? Yahoo, you've taken out a risk factor, and so therefore the valuation gets higher. So the question isn't, what stage will we do? It's how risky is it? How many risk factors are taken out? And if you've taken out enough risk factors, sometimes that's pre-revenue.
And let me add, the dude in the business plan is not a dude off the street. It's either got to be somebody we know or somebody that, we know of that we know. I mean, it's got to be 1 or 2 degrees separated at best.
We're sort of the same ilk as Jason's group is. We'll do that very early guy in a PowerPoint kind of opportunity. Or gal, person in a PowerPoint. The way we get away with that is what we're trying to invest there is not our dollars, but our time. And I think we've got more people per dollar of capital managed than any venture capital firm in the country. And we'll actually put our effort and resources into trying to build that company from that early stage. It's hard work, and that's why we're comfortable, though, not having, a team that exists day one. We're comfortable doing that with just a guy and helping him, or gal, and helping him build that team.
We've had a lot of guys or gals with business plans come in just because of our positioning, being so early stage. And we find that we would love for them to go out and raise a little angel money first, get their product up and running. I don't think we've invested in anything that's maybe even been through beta yet. So we're still doing very early. But we do want to see some proof of concept or some proof of technology or some proof of to Catherine's point, that they're putting together a team and they're making progress along. But then we do come in, I think, I would still classify it as very early, a lot of times pre-beta, and like Derek said, really throw our resources, our talent against helping the companies solidify and get their products completed and get into beta.
Yeah, I was actually just going through my portfolio as we were talking, and on life sciences, they're all pre-revenue, pre-product. So that's on IT, they're roughly half pre-revenue and half like some revenue, like maybe $100,000 quarter. Just a few customers that have bought. And by the way, people beta testing your product that haven't paid you are not customers. So don't tell me they are. They're prospects. They might become customers, and that would be great. But people come on. We've got 20 customers. How much revenue do you have? Well, we don't have any. So, that's a little pet peeve of mine. But yeah, so define that. It's really the early stage is tough. I actually might push back a little bit. There's a lot of venture firms that were early stage firms for 10 years, 15 years that are now only late stage firms, and that's how they build themselves. So there's actually a lot of people that have lately left early stage. So, it's like Web 2.0. What does early stage mean? I guess it's like company by company, right?
People always, you always hear it's got to be introduced. And part of it, for me, isn't that VCs are lazy and therefore we're not going to look through the other things. But it's also, it's a statement about the entrepreneur. If an entrepreneur cannot figure out, right, again, this stickiness, if they can't figure out how to use the network, how to find somebody, how to get that to be an introduction, how are they going to get customers? How are they going to attract employees? So it's not just that we're lazy. It's that it is a statement. And again, it's about risk factors. Okay, so if it comes introduced, that's a lower risk factor for me. And we do get inundated. And so it's a statement about an entrepreneur. If you can't figure out how to get somebody that we know to introduce it to us, you're going to have a hard time doing all the other things that it takes to build a company. So it's not just a cop-out. It's actually makes sense.
One other thing. And by the way, it's a hell of a lot easier to meet us in Boulder than it is us in the Silicon Valley. All right? For one, you're all here. Come up and say hi. Two, I mean, there's things, we've started, the Boulder branch of the Open Coffee Club, which a lot of people showed up. You know, it's every Tuesday at 8 it's BoulderOpenCoffeeClub.com, and the whole idea is that anybody in this room who wants to come can just hang out and get to know each other. So even if you don't know somebody knows one of us, come get to know us, have a cup of coffee, chill out. You know, David Cohen's running Techstars. I mean, there's all these different networks here that just don't exist in the Silicon Valley because there's so much noise to actual real meat ratio that these organizations don't survive the barriers. So you're very lucky to be in Boulder, that the community's small enough that you should be able to